Here are some depressed stocks that I'll be talking about today. And for reference, this is my portfolio. I bought into a number of depressed stocks, but I won't be covering any of these in my portfolio today. The first stock that I'll be covering is actually Novo Nordisk. Novo Nordisk is down around 40% year to date, currently trading at a 13 times of earnings, giving you a 3% dividend yield. So for Novo Nordisk, what exactly is the stock selling off? The stock is selling off because it is operating in a very competitive market. So you have Eli Lilly actively competing with this company, and Novo Nordisk is slowly losing market share. And you have multiple headwinds in the industry as well. So Trump, he recently talked about his most favored drug company in the entire world. So that will help to push down drug prices in the US, which will hurt the margins for Novo Nordisk. And you're seeing compounded versions of the drug floating around. So you're seeing companies like Hims and Hers selling compounded versions of the drug, which will also drive down margins for the company and drive down the sales growth for the company. And lastly, Novo Nordisk has terminal risk because your Wegovy as well as your Ozempic, it will expire in the US in around 2031. So in a few years' time, you will see all these drugs popping up in the market, and Novo Nordisk will basically lose around 80% of the revenue in that portion. So for Novo Nordisk, the bulls will say that the weight loss drug is growing rapidly. So this is the forecast for the weight loss drug industry. It is projected to grow between 24 and 27% CAGR all the way until 2028. So with Novo Nordisk being one of the larger companies in this space, it will likely be able to ride on this wave and move up in terms of its earnings. But for Novo Nordisk, I would avoid this name without a clear understanding of the company. The company is fundamentally great, but there is a lot of different things that you need to understand for the company. The company has its pipeline. The pipelines are not as strong as compared to Eli Lilly, and there's terminal risk with the name as well. It is very cheap nonetheless, but for me, it is an avoid. If you understand the industry, this could be an interesting time for you to look at this stock. The next stock that I'll be covering is Constellation Software. So Constellation Software is down around 16% since its highs. It is currently trading at a price to free cash flow of around 28 times. So for Constellation Software, why exactly is the stock selling off? The stock is selling off because of this AI killing software narrative that is floating around. So Monday.com, they reported their earnings about a week ago, and this was what the CEO actually came out and said. So they said that the general sentiment in software world today is negative, and then they also said that everyone understands that there is going to be a transformation in the software world, and the emergence of a new perception of what software will mean for organizations in the future is causing unrest. We are not alone in this. There is no software company that isn't going through it. But we are also changing along with the market and believe that with time, the results we present, including the use of AI and the adaptations of our products to these transformations, will speak for themselves. So what the CEO is saying is that your software companies are all facing the threat of AI because companies can create their own AI agents. Companies don't have to rely on these software companies to supply them with those software. They can create it on their own as a one-time expense, which is much better than a recurring basis that they're paying to all these software companies. And that's why all your software companies fell. And Constellation Software, which owns multiple different software companies, is a victim of this today as well. But for Constellation Software as well as all your software companies, what you have to understand is that sentiment will always follow price. So when your price fall, your sentiment fall, and that's what we're seeing with all these software companies today. The markets will always overestimate the risk, and the markets will always fall with a little bit of uncertainty. So even though the risk isn't showing in the numbers for all these different companies, the stock prices are falling, and this could be an opportunity for you to look into companies in the space. And for Constellation Software specifically, this is what their CEO said. Mark Leonard is probably one of the best CEOs in the entire world. He's on par with Warren Buffett, and I'm sure that if the company is in trouble, he will come out and face it as well. And this is what he said in its recent earnings call. So he said that I believe in many instances, we are the trusted IT partner of our customers and are the most logical source of AI knowledge and learning. And he also said that, and I think we're the most obvious source of those 90% AI solutions for clients. So what he's saying is that Constellation Software's companies are basically the AI solutions for a lot of their clients. And Constellation Software is actually a beneficiary from AI and not a victim of AI. So for Mark Leonard, he's one of the top CEOs out there. That is why Constellation Software owners have benefited so greatly from this stock over the past 10-20 years. So for the valuation today, it is currently trading at a 28 times price to free cash flow, around its average over the past 10 years. I think the company is around fair value today. And if you're looking for a margin of safety, you could look to around 25 times or even 20 times price to free cash flow. At that point, it will really be a discount for a company like this. The next stock that I'll be covering is ASML, one of my holdings. I know I said I won't be discussing my holdings, but ASML is one that is being dragged down by the broader semiconductor market today. So ASML is trading at a 25 times of earnings, currently around 5% up year to date. So for ASML, why exactly is the stock selling off? The stock has been selling off for around 2 months already. The stock is selling off because there's capex delay. So all your semiconductor companies have come out and said that there is a delay in terms of the capex, which is why growth could be slower in 2026. And the company also came out and said that there could be no growth in 2026. And besides that, the company is in the center of a tariff war because it's a European company and it deals with a lot of your Chinese consumers. So for ASML, the biggest risk that I see with the company is this portion here, which is the Chinese portion. So the Chinese portion is still around 27% of the entire revenue, which is not so good because your Chinese people, they are actively creating their own lithography tools. They're actively becoming more and more self-sufficient. And this could be the risk with the company. So ASML is one of the highest downside risk company in my entire portfolio. And China is trying to shift towards becoming self-reliant with all this lithography technology. And ASML having 27% of their revenues being tied to China will be cut to zero in the future if China becomes self-sufficient, if China can create their own lithography tools, which is what the companies in there are actively doing today. So you're seeing companies like Huawei, you're seeing companies like SMIC trying to create their own lithography products, spending billions and billions of dollars on R&D, which is multiples above ASML's R&D spend. So this is why, despite ASML being one of the highest quality companies out there, and trimming my position is actually not out of my consideration. The next stock that I'll be covering today is UPS. So UPS year to date is down around 28%. It is currently trading at a 13 times of earnings, giving you a 7% dividend yield. So for UPS, why exactly is the stock selling off? The stock is selling off because of tariff news, because of weak consumer data, and because your earnings actually came down by quite a fair bit. So the company is also trying to pull away from Amazon. So they've historically relied on Amazon for volumes, but currently they're trying to cut it by 50% to increase the margins for the company. But there are a few tailwinds and TCs for the company if I were to frame it. The first one is that UPS is strong in a lot of your different segments that Amazon is not actively involved in. So for example, UPS, you have your international freight, which is quite dominant in. You have your UPS healthcare logistics portion, which Amazon doesn't touch as well. And for this company, they have many other segments that are outside of your traditional US next day delivery. And the company is also trying to pivot away from Amazon, which could hurt volumes but increase margins. So what the company is trying to do now is they're trying to shift to more small and medium businesses. And that portion is also a lot faster growing as compared to your Amazon retail. So if the company is successful in doing so, they will not only be able to increase volumes in the long term, they'll also be able to increase their margins in the long term because they'll be the A side, they'll be the company with the leverage and not handing it over to Amazon. So for UPS, the thesis for the company is this. They're shifting to small medium businesses and you're seeing small medium businesses growing a lot faster than Amazon. So this is Shopify's revenue growth. Shopify serves a lot of your small and medium businesses, whereas Amazon serves more of the third-party sellers. And for Shopify, it's actually growing a lot faster as compared to Amazon. So this could be a tailwind for UPS, and if UPS is able to successfully execute this could be a long-term return story for the company. So the company's valuation today is at around a 13 times of earnings at a historical low. I think the company is undervalued today, but of course, if you're buying into the company and the economy falls, then this stock could go a lot lower. This is a company that is extremely tied to your entire economy, so beware of that if you're buying into a company like UPS. The last stock that I'll be covering today is one that is not really known. It's this company called FactSet. So FactSet is actually a data provider. It is an alternative to Bloomberg, Refinitiv, as well as Capital IQ. The company is trading at a 26 times of earnings today. So for FactSet, the metrics are incredible. So their retention rate, annual subscription value retention rate of upwards of 95%. They have client retention of 89%. And overall, the company has been going in line with the entire data market, the US as well. And for FactSet, it is a compounding machine. This is the net income for the company. The net income has just been growing almost every single year to the top right corner. And for FactSet, it is a highly recurring, predictable business that will just keep increasing their earnings over the next few years. The stock is down because the CEO recently retired. And there's a narrative floating around that FactSet is losing out to its competitors. While FactSet isn't the largest player in the space, it is a decently dominant one in the space, especially with this company having a highly recurring revenue business model. The last stock that I'll be covering is from this comment here. This comment says that, would you still consider Guizhou Maotai? So for Guizhou Maotai, they just reported their earnings. So their earnings came in line somewhat. So revenues increased by 7%, net profits increased by around 5%. So why exactly did Guizhou Maotai report such low earnings growth? It was because of a few different things. The first one is that your volume declined. And second one is that your Chinese government is imposing a lot of your alcohol bans in the country. But for Guizhou Maotai, it is a white mood business that I'm considering as well. So for Guizhou Maotai as well as your Chinese government, the Chinese government is imposing alcohol bans in China. I mean, this is nothing new. It is the Chinese government. So this could be a headwind for the company. And if the company continues to see volume decline, this could hurt the profitability of the business. But of course, Guizhou Maotai has something that all your other baijiu companies don't have. They have pricing power. So they have the ability to increase prices. And in 2023, I believe they increased the prices by 20% at one go. They increased the prices in 2017 as well at around 18%. So they will always impose these periodic price increases. And you can expect that in a few years' time as well. The company has consistently been able to increase volumes despite the price increases. And for Guizhou Maotai, I expect them to continually do so, especially since it is basically a national icon product in China. I hope you guys have found this one useful and invest safe.